Happy Friday, everyone. Thanks for tuning in to Business Daily. I'm Lee Ji-yoon in Seoul. We have plenty on our plate today, so let's get started with the day's highlights. The Korean government's push to get new duty-free stores open before older operations are shut down seems to be adding troubles for merchants behind the counter. From the first state visit to Europe by an Iranian president in almost 2 decades, to Facebook doubling fourth quarter profits to $1.56 billion, we look into some of the global business stories that made headlines this week. Although Korea's industrial output rebounded last month, many analysts remain skeptical on whether this will actually lead to a stronger recovery momentum this year, with lingering uncertainties abroad and business sentiment sitting low. Our Hwang Jae has this report.
Output across all industries in Korea was up 1.2% in December, marking the first rise in 3 months. Statistics Korea says the rebound came on the back of strong performance in the construction sector, boosted by sales of apartment units and government investment in infrastructure. But the numbers also come from a low base effect. Industrial output was on a downward trend for 2 straight months in November as production in the mining, manufacturing, and construction sectors was battered by slumping exports. And prospects for this year look dim, with the many unknowns that threatened the economy last year still very much present.
The slowdown in China, especially the investments by the Chinese government, will drag down shipments of Korea's major export items like capital goods.
With the pace of growth losing steam in the world's second largest economy on top of low global oil prices, sentiment on the corporate front is far from good. The Manufacturers Business Survey Index for this month fell 2 points from a month earlier to 65, according to the Bank of Korea, well under the benchmark 100, which means pessimists prevailed. The figure is the lowest since early 2009, when the country was struggling from the aftermath of the global financial crisis. And the feeble recovery momentum is stacking up pressure on the government to roll out more stimulus measures and on the central bank to cut key interest rates, especially as policymakers in major economies like Japan and Europe lean further towards loosening their monetary policies. Hwang Jae, Business Daily.
And speaking of loose monetary policies, in a surprise move, the Bank of Japan took interest rates into negative territory, a first rate adjustment since October 2010. In a tight 5-4 majority vote, the Japanese central bank said it will introduce an interest rate of minus 0.1% starting February 16th, but will impose it only on certain parts of reserves from financial institutions left with the BOJ. Authorities said they hope the negative rate will encourage consumers to save less and spend more, as well as push commercial banks to lend more, which may help the country to beat deflationary pressures and eventually reach its 2% inflation target. The Bank of Japan also plans to keep its asset buying program at the current pace, and investors responded positively to the news, with the benchmark Nikkei 225 shooting up 2.8%. Oil prices are continuing to rise on hopes that OPEC and non-OPEC producers might start coordinating production cuts. But analysts say while discussions are one thing, actual production cuts are unlikely in the near future. Our Son Jung-in has more.
Oil prices climbed for a third straight day Thursday, marking the first such streak this year. Both West Texas Intermediate and Brent crude for March delivery rose above $33 a barrel. The spike came amid speculation OPEC could soon slash production over a week after oil prices slumped to below $28 for the first time in 12 years. At one point during the trading session, oil prices had jumped as much as 8%. They were spurred by comments from Russia's energy minister, who said Saudi Arabia had proposed that oil-producing countries cut production by up to 5%. Russia, the top non-OPEC producer, has been struggling to cope with falling oil prices as it battles for market share with Saudi Arabia, the world's largest oil producer.
The most important trigger for this year is a possible drop in non-OPEC production. Such producers have very high costs, and current levels are too low for maintaining the current level of production.
But market watchers are skeptical an actual deal will be struck, as cuts by OPEC members could cause them to lose market share to non-OPEC competitors, and also with Iran, which has boosted oil exports after the lifting of sanctions.
We expect that volatility will be high for long term, maybe for this year and probably for next also. But overall, we expect a rebound in oil price.
It has also emerged that OPEC nations are trying to organize a meeting with non-member oil exporting countries next month to discuss production cuts. However, some analysts say it could be an attempt to shift market sentiment to boost prices. 손정인, Business Daily.
The global LCD TV market's on overall decline in shipments last year, but China-based brands managed to post growth despite the difficulties. According to research firm Witsview, Korea's Samsung and LG Electronics both posted annual on-year declines, although they did hold on to their respective first and second places in the global market. Chinese TV brand TCL, on the other hand, became the third highest TV shipper worldwide with 13.1 million units, followed by another brand from China, Hisense. The research firm says the surge in Chinese companies is due to high domestic demand, as well as the acquisition of other well-known international brands. Japan's Sony was knocked down to fifth place, shipping around 12 million units, down 19.3% from the previous year. A handful of duty-free operators were granted new licenses late last year to run downtown stores after going through a cutthroat competition, a battle that will repeat itself every 5 years. While the shorter period for license renewal was put in place to encourage greater competition, some say the preparations might have been too rushed. Our Lee Ju-young tells us what this is all about.
This is Hanwha Group's new Galleria Duty-Free 63 that started partial operations last month in downtown Seoul. With regulations stipulating new duty-free operators must open their stores within 6 months of winning their new licenses, Galleria says it did not have enough time to secure deals with top foreign luxury brands like Louis Vuitton, Hermes, and Chanel that have strong brand power over potential customers. Instead, newcomers like HDC, Shilla Duty Free, and Galleria have been running their stores with smaller Korean brands who are also facing increased pressure because of this rushed opening. First, sales are paltry. According to data from one mid-sized company, sales from its 2 new stores combined accounted for not even a fifth of its Lotte World duty-free operation scheduled for shutdown in the coming months. Not only that, smaller companies say the government's push to open up these new duty-free shops before older operations are shuttered has forced them to double the number of their employees and inventory, further adding to the burden. Despite the government's intention of firing up competition in the industry, smaller companies say current duty-free policies fail to address their needs and challenge their survival by forcing them to juggle multiple store operations and shoulder the losses. Lee Ju-young, Business Daily.
It's Friday, and that means it's time for a closer look through some of the global business stories that made headlines this week. And for that, we're now joined by our Eunice Kim in the studio. Hello, Eunice.
Hello, June.
All right, many eyes have been on Iran, including Korea's, after the historic lifting of the sanctions on Iran. Now, I understand the Iranian president has been on a tour to Europe this week and has inked some deals worth billions of dollars.
Yeah, you're absolutely right. And it's only been about 2 weeks now since those international sanctions were lifted, crippling as well. And now Iran is making it known to the West and the world that it's ready to be a player again in the global economy. Take a look.
Iran is open for business. That's the message Iranian President Hassan Rouhani had for Europe and the world as he embarked on his first overseas sojourn since being freed of the shackles of nuclear-related sanctions. His first overseas destination was Europe. On Monday, President Rouhani and a delegation of 120 headed to Italy, Iran's biggest trading partner second only to Germany. The two countries' business exchange amounted to 7 billion euros in pre-sanctions Iran. Rome's nude statues were covered for the conservative leader's visit in a warm welcome extended by the Italian Prime Minister himself.
Today we have signed the first agreements, and this is just the beginning of a journey. There are some sectors where we must work closer together.
The signed tentative deals are said to have amounted to 17 billion euros or about 18.6 billion US dollars. They included a pipeline contract worth $4 billion with an Italian oil service company. Others spanning everything from steel and infrastructure to energy.
We have worked well with Italy in many sectors. We have collaborated well with Italy, and we have to continue this cooperation to secure genuine peace in the Middle East.
Before heading to France on Wednesday, the leader of 77 million Muslims stopped by the Vatican to shake hands with the leader of the Catholic world. Pope Francis asked Rouhani to help promote peace in the Middle East. In fact, Rouhani would meet a chillier reception in Paris, as France had been one of the staunchest critics of Iran in the run-up to the lifting of international sanctions. Some 15 billion euros in deals were inked, including one that would purchase 118 Airbus planes. But French President François Hollande pressed his Iranian counterpart to help bring some semblance of normalcy in Syria, a country mired in years of conflict, in part tied to Tehran-backed leader Bashar al-Assad.
We are trying our best to bridge the differences in our views regarding all these problems. Even their differences, they are understandable. We need to continue to work together.
Well, it looks like the Iranian leader is on to a strong start with a large delegation of business leaders and ministers. But how important is it for Iran to get this right?
It's very important, of course, since Iran's really been left out to dry for decades under these international sanctions. They have a lot to catch up on. Iran's economy is second only to Saudi Arabia in the Middle East, and its people are highly educated. So this is very much a matter of restarting business for Iran. Now, one of the deals, for instance, was to resume a car-making partnership between France's Peugeot and Iran's Khodro car maker, using parts made in Iran. But it's also still a country facing great criticism from the West for human rights abuses and for its support of Syrian President Bashar al-Assad, whose iron fist many experts say contributed to the success of the Islamic State group in that region. And France, in fact, has been pushing for new sanctions against Iran for recent ballistic missile tests. Important to point out, their agreements are very much still contingent on Tehran not breaking any of the rules in the nuclear pact. But the need is also mutual. At a time when business sentiment around the world is not great at all, Iran presents itself as a rare opportunity for investment and growth.
All right, let's leave that there and head on to a different space, a digital space. All right, social media darling Facebook announced its fourth quarter results yesterday, and it really did blow everyone out of the water.
Right, Mark Zuckerberg really come a long way since his Harvard dormitory days, hasn't he? As this latest report is showing that an internet company can indeed make some significant cash. At a time when even tech is struggling under global economic pressure, Facebook announced on Thursday it not only registered growth, but more than doubled its fourth quarter profits to the tune of $1.56 billion. Now, this does mark the 10th consecutive quarter Facebook has beat analyst expectations. The social media giant said it cranked up the number of ads by 29% in the October through December period, which helped drive that year-on-year growth. Now, get this, it said 80% of its ad revenue came from mobile users, as monthly active users rose 14%. And also, this is significant, the volume of video play amounted to 100 million hours a day. And this is seen as a move of Facebook trying to chase down YouTube in some respects.
Well, I think this is great news, as we heard disappointing data coming out of tech giants like Samsung and Apple. So can we say we're seeing a start to an era where the growth is online?
Well, it certainly seems so at this point. And in fact, market watchers have even coined a term, an acronym for the most successful web entities. Let's go ahead and see how their stocks did over the course of last year. Now, as you can see, the stocks of FANG, that's Facebook, Amazon, Netflix, and Google, all registered gains last year. But if we look at Apple's, you see it in gray right there, its performance actually dropped in value. Experts point to the flexibility of online companies driven by a great idea or a great need, not needing a lot of infrastructure or capital than, say, a manufacturing firm. Now, investors seem to love Facebook right now as its stock surged 15.5% on Thursday, bumping NASDAQ up to positive territory. It also bumped Mark Zuckerberg's net worth to $46 billion, making him the 6th wealthiest in the world. Not a bad way to start this year, notably as on Monday was his first day back at the office after that 3-month paternity leave, a decision that had also created a fair amount of buzz.
Wow, a 3-month paternity leave.
Yeah, and some people are joking that if this is what a paternity leave does for a company, maybe Maxima Zuckerberg should be looking at more siblings as well.
Yes, I think so too. Thank you so much for coming in today, Eunice.
You bet.
And that wraps it up for today and this week. Thanks so much for watching, and we'll be back next week at the same time, same place for your Business Daily. Have a great weekend, everyone.